Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a favorite, Nomi Prins. Nomi Prins, thank you very much for joining us.
Thanks for having me on again, Greg.
I'm going to continue with your introduction. You know, you're a former managing director at Goldman Sachs. You've written a bunch of books, including the bestseller, the most recent book, which is It Takes a Pillage. Also, you have a new book coming out, All the President's Bankers, coming out next April. You're a busy woman. You've got a new article out, which is why I have you on. It was on just last week, and it's called The Fed's Employment, Taper Myth, Big Bank Stocks and Downgrades, and it pretty much wraps up the entire, what's been going on in banking. And one of the nuggets is a long, meaty article, but one of the nuggets was you were talking about how the Fed really doesn't increase employment. I mean, the labor participation rate is at 30-year lows, but the bank stocks sure are doing well. Tell us about that.
Yeah, there's this myth that prevails throughout Washington and a lot of the media that somehow the Fed's quantitative easing program of buying securities is helping to create jobs. And there really isn't a relationship between buying mortgage-backed securities and jobs appearing. What's really going on is, by virtue of buying these mortgage-backed securities and treasuries, what the Fed has been able to do is help banks, particularly the big six banks that are still doing poorly with respect to their mortgage portfolios, though they don't tell us that. The Fed doesn't tell us that. To be able to mark these things higher, to get rid of things that they don't want, and that in turn has helped their stock prices. Now, as we know, the entire stock market has been going up since March 2009, since the Fed began all of its aspects of buying securities and putting liquidity into the system, and particularly since round 3 of QE that started last September. But the big six bank stocks are outperforming the rise in the stock market generally by 10 times. And that's something that's really not discussed out there too much, and it's a big multiple.
That is an OMG moment. When I read that in your article, I went, maybe this is really what the Federal Reserve is trying to do, keep these insolvent banks from imploding while they're buying what they say $40 billion a month. My sources say it's much higher. They're reinvesting it. They say it's much higher. But that's what they're really doing. And the labor participation, you can look at the unemployment number, but if you also look at the labor participation rate, if it was the same as when President Obama took office, we'd be at 11%. That's the headline number. If you did it the way it was done in 1994 and earlier, according to John Williams, you're looking at 22, 23%. I mean, this is a disaster. And to your point, you talked about how, I wanted to just bring this out, that you say it's a 100-year anniversary of the Fed coming up, and the Fed bank is the bankers to the Fed, to the banks, not to the people. Explain that.
That's right. I mean, in the research I did for All the President's Bankers, in reading just the first title of the Federal Reserve Act in 1913, which was signed by President Wilson into law on December 23rd, 1913, it specifically does not talk about employment levels. And not only that, in the conversations that went on in Washington 100 years ago, there were no discussions, there were no letters, there were no memos that went back and forth between the various senators and bankers and presidents who were involved before Wilson that related to employment. It was really about protecting two things, the banks and their perception of protecting the dollar as the United States became a world superpower from a financial perspective. Those were the two reasons the Federal Reserve System was created as it was created. And putting the dollar aside, today the Fed is there, has been there to support its member banks. It supports its member banks in proportion to how big they are. The biggest banks get more support. And, as we were talking about the stock prices before and the rise of those big six banks, they are the ones that have received more support from the Fed. They are the ones whose securities have been purchased by the Fed in return for loans or cash or various other subsidies. They are the ones who have seen the most benefit, and they're the ones that are still in trouble. So it all really ties back to this idea that the Fed is not about employment. That's a political buzz conversation that happens in Washington, that happens by Fed chairmen, that happens some places in the press, but it isn't true.
And nobody in Congress, when Bernanke or Yellen was up there, Yellen knows this, which banks are getting $40 billion a month? Which banks? And nobody will ask that. They'll fight over $85 billion a year in this stupid sequestration, but a $500 billion a year in Fed largesse to, 5 or 6 banks, we don't care. I don't get that. That's absolutely outrageous. It's too stupid to be stupid.
It is outrageous. The Fed's amassed $1.4 trillion worth of mortgage-backed securities in addition to its other $2.4 trillion of Treasury securities, most of which are in excess to what banks are even required to have at the Fed in order to participate as members of the Federal Reserve System. So the Fed is definitely buying more. It's buying more from the bigger banks because those are the banks that created the securities. Those are the banks. And here's a good proof. This is a report I just found. The New York Fed puts it out every quarter and doesn't really create a big press release splash about it, but every quarter it takes a look at all the banks in the system. And it divides out the 6 big banks, the big 6. Those are banks that have assets of more than $500 billion. Those are the ones that have had the most trouble. Those are the ones that have caused the most trouble. Those are the ones that created the toxic securities. Those are the ones going through litigation and settlements. Those are the ones that have never pledged, I did it on a single felony charge. Those banks. And they're still in trouble. If you look at the New York Fed report, it specifically indicates that the level of non-performing mortgages as a percentage of all the assets that these big 6 banks hold is still at pre-crisis to crisis levels. It hasn't gone down. So with all of the $1.4 trillion of buying, with all of the extra liquidity, with the 0 interest rates on cash, with every present these big banks have gotten, the crux of the problem still exists, and it is triple the level non-performing mortgages relative to all of their assets at the big 6 banks as it is to all of the other banks in the banking system. So it is specifically and definitely these banks that are still having problems, and then they're still being helped widely and very disproportionately.
So we could still have a banking calamity, and a big one, is what you're saying. I mean, could the FDIC... I guess I should say, because I know this, the FDIC really couldn't handle a Goldman Sachs that has, 113 billion in assets and something like 40 trillion in derivatives. I mean, the leverage and the ability for these banks to survive without the Fed is staggering, isn't it? I mean, couldn't we have a big collapse?
The banks can't survive without the Fed support, period. As evidenced by the fact that the securities at the crux of the problem, some have matured, some have defaulted, but the levels of problems are similar to what they were before and during the crisis. And the level of money that these big banks are trying to make out of trading, out of securities that are, and transactions that are harder to monitor is higher than it was during the crisis relative to their other activities. That includes derivatives, that includes all sorts of other trading activities. And again, specifically, these big 6 banks, as the New York Fed divides them out relative to the rest of the banking system. Without the Fed, there would be none of this support. It's all very, very artificial. The FDIC could definitely not handle a banking crisis of the magnitude that could happen. And the reason that the Fed's support continues to be there and that this talk of, tapering happening is kind of ridiculous, because the Fed every month talks about how they're basically not going to taper. Janet Yellen in her statement to the Senate last month also said that they need to continue to help the markets. When they say markets, they mean the banks, they mean the big banks, they mean the ones that are still dealing with problems that they created.
Yes, that they created. So so handicap another banking calamity in 2014. What is likely to happen in 2014? Are we just going to have more of the same, or could we have some type of black swan that could crush the system?
Either of those two things could happen. The Fed, I believe, will not discontinue its program of helping these banks. It will not discontinue buying these securities because the levels of problems are still the same. So, if you look at unemployment figures and you want to believe that's associated with the Fed, you can have a taper discussion. But because, as we've just discussed, it isn't, what's really happening here is the Fed is continuing to help these member banks. Since their problems are still there, I think the Fed will continue to help, which means we'll kind of have this status quo situation. There'll be, markets will go down when people think that there might be a taper. Markets will go back up when they realize there won't be. And that kind of level is going to continue, and the Fed's help is going to continue. The FDIC is going to continue to be there, ensuring depositors in this mode of status quo. But if there really were a catastrophe, which is the other possibility, if something goes belly up in the codependent derivatives that still exist among these banks, that could create another major leg of this crisis. But I think the Fed is so scared to allow that to happen that they are going to continue to plug liquidity into the system to help with these mortgage-backed securities, to help massage the big banks' problems as they continue to engage in settlements where they're basically paying pennies on their profits into these litigation situations. And I think that's going to really be a lot of what's going to happen in 2014.
Well, you brought up in your article, we didn't touch on this, but in the final thing is that with all this largeness and QE 1, 2, 3, and what apparently looks like infinity, they still got some big bank downgrades. And I find that stunning after all the bond buying, after all the QE, after all this money pumped into these big banks. We had, 4 big banks take a big hit in terms of a downgrade, which I find stunning. Tell me about that.
Well, yeah, Moody's downgraded 3 of those big 6 banks, and also Bank of New York. So they downgraded J.P. Morgan and Goldman Sachs and I believe Morgan Stanley. But the point is that their reasoning for downgrading was sort of this parallel universe reasoning where they said that was because these banks have had to put in these resolution agreements with the Federal Reserve as part of the Dodd-Frank Act, Title II of the Dodd-Frank Act, that says you need to have these living will resolution agreements. And based on how Moody's perceived these agreements to go, it said that these agreements say that in the event of another crisis, banks will take care of themselves and the fallout will not attack the U.S. taxpayer and the rest of the economy and citizenry. So they're saying these resolution agreements actually do that. They're right to downgrade. These banks, as we're just talking about, continue to be weak and continue to be buoyed by the Fed. So they're right in downgrading these banks. In my opinion, these banks should be downgraded way more. But the reasoning of attaching it to these resolution agreements is ridiculous because I've read these resolution agreements. They're 31 pages or so each. In that article I wrote, I specifically threw some examples of just Goldman Sachs and J.P. Morgan Chase, in which there's 30 out of 31 of those pages just talk about what the bank does. Here's our businesses, here's the international side, here's our assets, their liabilities. It's cutting and pasting from their SEC filings anyway. But then on the last page of them, they say, well, in the event of, another crisis, we will basically attempt to create an orderly resolution of the crisis, in which the FDIC becomes the bridge bank or creates a bridge bank of last resort where they will take supposedly all the toxic waste from these banks if these banks can't sell it elsewhere, can't sell themselves elsewhere, or can't find another solution before bankruptcy would occur. The banks in their agreements say this will be done in an orderly fashion. And because they say so, apparently we're supposed to believe that will be so, or at least that was Moody's reasoning for the downgrade. And I believe that's a reason that people who believe the Dodd-Frank Act has done anything reformative to the banking system will probably think that these resolution agreements mean anything. They really don't. They're just recapping of what happens when any bank goes into trouble. There's nothing different, and there's nothing in them that will actually protect the American population from a banking crisis. There's absolutely nothing in there that does anything creative in that regard.
So taxpayers will be on the hook again, in your mind?
Will definitely be on the hook, whether it's through an exact TARP-like bailout, or whether it's through the Treasury Department issuing more debt to continue to buoy the banks, which then go through the banks to the Fed as excess reserves, or the Fed creates liquidity in a different way. However it works, whatever you call it, it'll be a situation where the financial system and the Treasury system and the Federal Reserve will be buoying banks at the expense of the population. It might not be a congressional act. It doesn't matter. It might not be funded by a Congress saying yes, but that was a small portion of the subsidies the banks get anyway. So yes, we would be on the hook as a nation in the event of any banking major crisis.
And could there be bail-ins? I mean, you're a former banker, and we hear this all the time. People want to know if their money can be taken out of a bank, out of a J.P. Morgan, or J.P. Morgan Chase, or out of a Wells Fargo, or they're talking. Jim Sinclair is out there saying, "Oh, bail-ins are coming." Many of my guests say, "Oh, when it crashes, people are going to lose some money. Bail-ins are coming here in America." What do you say, being a former Goldman Sachs top banker?
Well, again, reading these resolution agreements where the FDIC would really be the backstop of the most toxic components of banks in the event of a major banking crisis or crash, or a combination of some of the big six having a crisis or crashing. And, sidebar, Citigroup stock went down to $1, during the worst part. These things can happen. These things are still in play, the potential for these types of crises. This hasn't gone away. I think that the idea that the FDIC would be unable to really take on that kind of responsibility could result in, some depositor lockouts or bail-ins or what have you. Now, these resolution agreements don't discuss that, obviously, because that would freak all the politicians out, and it would, be actually interpreted as very different from what it is. But they do say that, some of the bondholders could face losses. Now, if you purchase bonds, you effectively lend money to an institution or any endeavor in return for some interest. So you should expect to lose money if what you're investing in tanks. That's fine. But there's those two sides of a bail-in. There's the bondholders who should lose money in the event of banks collapsing.
But depositors, they say that the depositors' money is the bank's money.
And it is, but that is a danger, that the depositors could lose money because the FDIC, who was insuring those deposits, would not be able to contain a mega fallout. Then
trillions of dollars.
Deposits become are at risk, and depositors, taxpayers, citizens, don't have the ability of a bond buyer to analyze a bank and decide to or not to invest in it. These are big six banks that contain 60% of the deposits or more of the nation. So they are very powerful in terms of holding people's money, and it is at risk because their resolution agreements are dealing with an FDIC insurer that isn't constructed to have the capacity to cover them. And so what's left? Cash depositors. Now, again, the Fed and all sorts of other subsidies will be thrown at these banks anyway because they care more about their own survival than their depositors' survival. But it is all tied in.
And in closing, 2014, if you want to hazard a prediction or the probability, what do you think is going to be the big headline or headlines? What's likely to happen in 2014? And if you want to take a guess at this.
Again, I really don't see anything major changing on the horizon. I see the Fed continuing to do what it's doing. I don't think if when Janet Yellen becomes the chairperson that she's going to do anything different from Ben Bernanke. The language that she uses might be analyzed differently. It might cause some extra volatility in the market as it comes up and down. Might cause some extra volatility in the dollar, some more volatility in gold and so forth. But I really think that the policies in place and the level of insecurity that the banks currently pose to the rest of the economy are still going to exist. And I think that, therefore, the Fed's going to continue to do what it's doing. The market's going to continue to do what it's doing. The bank stocks are going to continue to outperform the market as they've been doing because they're getting all this extra help. And I don't think there's a lot coming out in 2014 right now to really change that status quo. Now, that doesn't mean there can't be an emergency, but just right now, I don't see it. It's very covered by all of these institutions working together right now.
So 2014, your prediction? More of the same.
More of the same.
And there's still a high level of risk?
Yes, covering a high level of risk. More of the same policies covering a similar level of risk.
Which is high?
Creating a facade of stability that will continue until it falls apart.
Nomi Prins, NomiPrins.com. Oh, before we go, your book is coming out in when? All the President's Bankers in April of 2014?
Yeah, that's right. It'll be out April 8th, 2014.
Ah, super. And hopefully you'll come back on and you'll talk about it on USA Watchdog, right?
That'd be great. I'd love to.
All right. It's a booking. Let's see. And as close, just want to give you a little plug here. NomiPrins.com. This article, the stuff that she's talking about, is on NomiPrins.com. You should go on and read it. It came out just last week. Nomi Prins, thank you so much for being on USA Watchdog.
Thank you so much, Greg.